Hello, everybody. My name is Andrew Dix, and I am the founder and CEO of Crowded Media Group. And we are the publishers of CrowdFund Insider, and we cover the full stack of fintech topics, including online capital formation or securities crowdfunding. And today we're here to talk about what's next crowdfunding. And once again, we have a number of experts that are here to share their insight and knowledge on the industry. And to start things off, I'm going to ask each of you to introduce yourself, and we're going to start with Rebecca from Dealmaker. So please tell us who you are, what you do, and why you're so amazing.
Thank you, Andrew. Rebecca Casaba, CEO and co-founder of Dealmaker, primary issuance platform, leading primary issuance platform in the space with 8 out of the largest 10 raises in America completed last year.
Wow, I didn't know that. 8 out of 10. Okay, we need to, after this, we need to talk because I want some more information on that. I didn't know that. That's really cool. All right, Jamie.
I'm happy to make a sale. Yeah.
Perfect. All right, Jamie.
I'm Jamie Finn. I'm president and co-founder of Securitize. We are a firm that works with companies basically from inception all the way through to IPO in a variety of different capacities. We're a broker-dealer. We operate a primary and secondary market for trading of private securities, and we're also a transfer agent. We have about 1.2 million investors on the platform, over 3,000 issuers as customers today. And we are operating both in the US and in Europe, which we announced yesterday. And so we're expanding. We also have a significant operation in Japan.
Yeah, that's cool. Your news announced yesterday is awesome, and we're going to talk about that in a little bit because I want to learn more about this. But that was a big deal for the industry, not just yourself. Joel, tell me.
Hi, Joel Steinmetz. I'm COO and co-founder of Rialto Markets. Rialto is a FINRA-registered broker-dealer as well as an SEC-recognized alternative trading system. And we help companies raise capital in the primary markets in private securities. And if they choose to do so, actually have them traded in the secondary market as well, so that they can give their customers and investors a monetization opportunity in the secondary market, as well as gaining new customers within that secondary market. We're agnostic as to industry. We work with all kinds of firms, as long as it's private securities and regulated securities specifically. We'll help them raise capital and help them do the trading in secondary markets.
Awesome. All right. So to kick things off here, investment crowdfunding was legalized in the U.S. under the Jobs Act of 2012, which many people understand and know about. Unfortunately, it took the SEC a few years to really, finalize the rules with Reg CF becoming actionable in 2016. But as it stands today, we have 3 different exemptions that issuers may leverage to raise capital online: Reg CF, Reg A+, and Reg D 506C, which is only available to accredited investors. Since the Jobs Act was signed into law, platforms have come and gone. Some have done very well, some, okay. It's a constantly evolving and iterating industry. Not too long ago, the SEC, they made some material changes to the ecosystem. They took Reg CF from an anemic 1.07 million funding cap, which in my opinion was really not viable, and raised it to 5 million, which makes a lot more sense. Reg A+ is now, an issuer is now able to raise up to 75 million. So now you're starting to talk about some real money. Then of course, Reg D 506C, you've always been able to raise an unlimited amount of money. So what you're seeing is platforms have adapted, and they will frequently do a side-by-side securities offering with the issuers and the investors. And not too long ago, Senate Banking Committee members introduced the Jobs Act 4.0. And this is an aggregation of about 30 different bills that are each designed to improve the entrepreneurial ecosystem, the crowdfunding ecosystem in different respects. And so I'm going to go around the table here and get some feedback and input on where you see opportunity here, and what are the aspects of this legislation that you see are most exciting. I'm going to start with Rebecca, because I know that she has been reading this 1,000-page long act of legislation, haven't you, Rebecca?
Yeah, that's what I like to do in my spare time, for sure, Andrew. No, I mean, any of those 30 pieces, if they get passed, I'm really excited about the effect that's going to have on our space. There's a couple that I would call out that I'm particularly excited about. Exempting finders. I think finders play a huge role in the ecosystem. And so allowing more clarity on finder activity brings more experts to the space, which will help more issuers raise capital. Less state registration for crowdfunding portals, allow more portals to get out there and do what they do best, and make that a really cost-effective model where they're helping with smaller types of raises. Self-certification of investors, so allowing more deals to get done under Reg D, where they're easy to get spun up really quickly. If you can get more capital flowing under Reg D, that's going to be a huge boon for the space. I know Jamie and Joel would be excited about the changes about the increased ability for Reg A securities to secondarily trade within states, like anything like that, right down to like the bad actors database that's proposed, just giving like more streamlined and more clarity for people like us operating in the space so that we can really streamline what we're doing. Because right now, with all the 19% drop in VC funding year over year that the market's seeing, our space is the one that's leading companies to get funded. And I know we'll get into that, but all of these kinds of changes, it's so great to see them being recognized and more support for our space.
So you mentioned finders, which I agree with you. It's a big deal, and the SEC has been talking about it for years, and Congress has tried to change it many times. It just doesn't happen. Could you explain for an audience how a finder operates and why it's important very quickly?
Yeah, I mean, there's a lot of complexity with these offerings, and finders might have a network of maybe accredited investors who can help seed a company. And so that can get a business plan from concept into reality of a fully formed company that has some capital that can now launch a bigger Reg A plus or a bigger raise like that. And so finders play a key role in the system in advising companies so companies can do what they do best, and they can have some advice on their capital markets activity, how to stack their raises, how to get the company capitalized, right? Because like every founder doesn't need to learn that. They need to build the business, and the advisors can help them do that in a really cost-effective way.
So a finder can help them find money.
Help find money, help give advice on how to like do your valuation or how to raise next rounds of money, and definitely help bring in checks.
All right, Jamie, Jobs Act 4.0.
Well, I mean,
where
in
are the
fairness,
opportunities?
I think Rebecca took the highlights there, so it was good. I mean, I think from our side, it's all about reducing friction and letting people get into deals as easily as possible, right? So definitely when we look at sort of the conversion funnel and for Reg D placement, so I think that change is extremely significant. Obviously, the ability to trade these securities a little bit more easily is wonderful as well. But for us, like most of the money at the end of the day right now still comes from accredited investors. And whilst we've done a few retail offerings, even in the retail offerings, it's still 80-20. You're going to get, kind of your anchor investors are going to take 80% of the deal. Retail is going to take 20. And I think that's great because it gives kind of validation to the deal, because obviously a sophisticated investor should have better insight, especially if they're going to spend millions of dollars on a deal.
I think the accredited investor item is huge. Mm-hmm. It potentially could be a game changer. And I haven't read this most recent legislative action. I just know it's cooked in there someplace. Mm-hmm. Even if you can just self-certify, without handing over your tax statements.
Well, like you do on a 506B,
that's a big deal. Yeah, if you can, there's a some sort of test that not anything. We're not talking about a Series 7 test, but some sort of certification where you acknowledge that, hey, this is a risky investment and I understand how this all works.
Yeah.
I think that could be game changing too, and it would be impactful for everybody: investors, platforms, issuers. I think for the three of you, it'd be huge. Yeah.
Yeah, I was disappointed they didn't address really the investor counts. I think that's one of the limitations that doesn't make sense technologically anymore. I would have liked to have seen them remove the 2,000 investor threshold. I think that's still extremely low, and it leads to bad behavior such as hiding people in SPVs and things like that in order to bring more investors into the deal, which is the worst outcome because you don't have the look through into the actual investor. So I think that's a missed opportunity in my opinion.
I totally agree. That's a good call out.
Joel, tell me.
Well, firstly, I'll echo Jamie's sentiment that Rebecca really hit on the highlights, which is great. But I'm just going to focus on a few of them and maybe add one point. The finders bit is extremely important, and the reason for that is that it's so difficult to have them come in now. And if you ask any issuer, if you ask anyone in the industry, the hardest part is actually getting the capital in. And if you can spread that net wider, why not give the opportunity for small businesses to be able to spread the net as wide as possible in order to get in the most amount of capital as possible? And easing that finder capability is essential to making sure these companies can be successful. The second piece that I'm going to emphasize is the secondary markets. We often focus on the secondary market's advantage in the secondary market. But in actuality, one of the great advantages of a secondary market is for primary investment. When you're investing in a deal, how are you going to monetize that investment? Well, nowadays, companies are staying private for 13 plus years. So when you invest in a company and you ask, well, what's the exit strategy? And they tell you, well, hopefully in 10 to 12 years, we're going to have a go IPO or we're going to get acquired. Well, my kid's going to college in 4 years. And I have to buy a new house in 6 years. Yeah. How am I going to get that money? So when you have the secondary market that's available, you have opened up a world of primary investors that wouldn't invest in it now because they can't hold their money up that long. The third one is, yes, the Reg D is very important. One of the things that we have to figure out is how to make the entire process of raising capital more efficient. Reg D right now is the quickest way, but it has so many other issues upon it or components that have to be dealt with. If we can find a way to reduce the amount of time to get people through the right processes, regulated to make sure they're not doing anything they shouldn't be doing, but do it quicker, that would be essential. But the last piece I just want to enter is, yes, there are 30 pieces of legislation. We would love to have any of them come through. But if you're following what Gensler's saying now and what's going on, there's a lot coming. And whether it's these pieces of legislation or other pieces of legislation that have impact upon private securities markets in any manner, shape, or form, upon the digital markets in any manner, shape, or form, and how the nexus between private securities and digital need each other, that's going to definitely impact what ultimately comes out of the legislature.
Yeah, 13 years. I'm going to be in an old folks home by then. Good Lord. Yeah, and it'd really be impactful for the entire industry. So somebody mentioned to me yesterday that they see Jobs Act 4.0 as just as impactful, more so than the Jobs Act of 2012. So I think that's very exciting. So I want to jump to the next topic. I think that we have all observed as the industry has evolved is we've started at kind of smaller deals frequently and people focusing on startups. But I think that the industry realizes that raising capital online makes sense for any private firm. And so now we're seeing, large issuers or larger issuers raise capital online. And I'm seeing, multiple securities crowdfunding rounds. I'm seeing, participation with, venture capitalists. I think this is a trend that's just getting going. Rebecca, am I right? Am I wrong? What are you seeing?
Absolutely. I mean, we're launching, 40 plus new primary issuance deals a month. That number is only going up. If you look at the Form 1A and the Form C filings for Reg A and CFs, those continue to be up year over year. And we've definitely seen in the number of years that we've been in the space, just better and better deals in terms of bigger deals, higher revenue companies coming into the space. And I think that trend is only going to continue this year as we see, VC funding 19% down, big unicorn deals 18% down. Our sales team is having conversations with huge consumer-facing brands who are looking to monetize their community and realizing that their community is an asset. And when our digital marketing department steps up and shows, look, guys, even with everything that's going on in the world, our return on ad spend, or our ROAS, is tracking very well. We're filling deals. Just last week, we filled one deal, $6 million. That's over $1 million they're closing a day. People are sitting up and they're saying, you know what, Rebecca, this Reg A thing you've been telling me about for a while, it's time that we really have a serious conversation about this now, because those investor acquisition campaigns are working, and all the people on this call are continuing to make this process more streamlined, more easy, and that just leads to better returns for the issuers. So it's a great thing. Bigger companies, better returns for the investors, more diversified portfolios. It's all good stuff for this space.
So you're not crazy. Reg A Plus is working, right, Rebecca?
It's working. It's working.
Joel, is she spot on?
It's definitely working, and as Rebecca had said, as is Reg CF. Reg CF is really working very well. This raise to $5 million has been a tremendous boon. Companies that are real, I'll tell you, 4 years ago, when we were getting calls from issuers, we were saying no to 98% because they were mostly companies that either had tried every way, 8 ways to Sunday to try to raise capital and couldn't do it, or had, figured they might as well just try to raise capital somehow and get into the market somehow. And they'd call you up and say, oh, here's someone new we can try with. If you look at the last 18 to 24 months, it's completely different. These are real companies. Even if it's seed capital, it's companies that are, earning some money, making some revenue, looking to expand, not only to seed the company, but maybe just to seed a project. And they're companies that are getting real interest from not only the retail investment community, but the institutional investment community. And we've seen the power of retail. I've said many times, if GameStop taught us anything, it taught us the power of the retail. And that retail investor is not someone now who's just a follower. They're very often a leader. So they start to play off each other. And to Rebecca's point of building community, when you can have your customers become investors and your investors become your customers, you have now created a community that enables you to expand on both sides of the coin. The next time you're looking to raise capital for some expansion, you have a group to go to. And the next product that you deliver, you have a group to go to. And now you've created a tremendous community that spreads the word of the value that you can present to the marketplace.
You need to cut a commercial with that. I mean, before it was 98% that were, people that saying, well, we'll stick it to retail. But now you have real companies raising real money, seeing it as an opportunity to engage with investors as well as big money. I mean, that's what we want to hear. I mean, that's what the whole entire industry is about, Joel. I mean, right. That's phenomenal. It's great to hear that. Jamie, you're not going to disagree with Rebecca and Joel, are you?
Nope, I am not. We worked on the Exodus offering where they raised $75 million through Reg A Plus, which was a great success. I think it was the first time somebody raised that amount.
It is
nice.
Yeah.
And then it was the cool thing about it is because of our platform, it was tokenized, and so that is trading now on our ATS. It also trades on other ATSs, which is one of the unique aspects of what we can do. And people own their shares and they actually have them sitting in their wallets, which is pretty cool. So, I mean, there's a lot of new features and functionality coming there that give actual ownership to shareholders, not just conceptual ownership, that they can do stuff with their securities, which I think is also an area that has a lot of opportunity for innovation.
Yeah, well, I'm going to come back to that
Sure.
here in a second, because I think that's, in my opinion, that's key to the future of the industry. I wanted to jump back to Joel for a second, because we're seeing new asset classes added. Everyone's seeing that. And some of you guys are participating in this, like collectibles, funds, other items that can be, bought, sold, and traded. Joel, you've talked a lot in the past about fractionalization. What are you doing with that today and now?
Well, we're involved with several companies that are actually fractionalizing ownership of anything. We deal with places that are doing with art and music and real estate and a whole bunch of other industries, wine collections, etc. All of those have the possibility of just fractionalizing ownership. So if you wanted to own that Van Gogh and you just don't have that kind of money, you now have the opportunity to invest a small amount and get involved. And here are these investment opportunities to a much wider range. What has been the stumbling block for all of these is the operational efficiency of enabling that capability, that investment opportunity for the investor and the outreach opportunity for the issuer to reach those investors. And a few years ago, there was no ability to be able to do that, because you had to put in all the component parts, whether it was the buying, the trading, the escrow account, the payment rails, the transfer agent, all those pieces of the puzzle you had to put together yourself. And now there are teams of people, technology works, and companies like ours, like all three of ours, that enable that capability and enable the what we call it at Rialto, we often say we built it for institutional strength and retail scale. It's got all the capability to handle all of the complexities that institutions require, but scale so that there can be thousands and thousands of investors on that cap table, and it's just as smooth as if there were 10 investors. That's been the issue. Once you've accomplished that within the framework of the ecosystem, you can now, in essence, fractionalize any asset so that the asset can be digitized and turned into, or not digitized, you can even do it in the traditional form, but turned into a private security that is available for all kinds of investors, depending on the regulation you're choosing and the exemption you're choosing, but it can be available to all kinds of investors in various shapes and forms. That's a whole new world to the asset. If you think about it, I've been in this industry, maybe on screen, I hope you can tell how old I am, but I've been around a long time, and there really weren't that many new innovations.
I agree. It's spot on. Rebecca, is your company doing a lot of different new asset classes?
Yeah, I think it depends on what our issuers are launching, and they can launch any type of security on Dealmaker. So that might be, anything from a sub-receipt to a debt security to a share to a fractionalized share. So to me, I always like to say, retail capital raising is the compliant way that issuers can harness the energy of all these movements, right? Whether it's the constitutional DAO or it's NFTs or it's art on OpenSea, right? It's that same movement that all three of us are taking the legislation and harnessing the energy of those movements in the way that people can now use that to raise capital for their businesses that will really fund the economy and the GDP in a meaningful way. So we're translating that energy into something that gives real power to the economy, which is really exciting. And the thing that I really love to see in Jobs Act 4.0 was the recognition by the legislators that these investors know what they're doing, right? If you look when our deals go live, there'll be, threads on Reddit, people talking about the deal and the securities. There is this recognition now of these investors understanding and having access to the internet and information that they can buy these assets, and that's okay. And I love to see that.
NFTs are securities, right?
Well, no, we're not going to go there.
Not going to go there. Okay. All right. So I'm back to Jamie, and saving you for last year because you're digital security native, right? You started this path, and in many ways, you're kind of a pioneer. There's right? I mean, for better or for worse. Like, I'm sure you have many battle wounds and stories to tell for another webinar, perhaps. Where's this digital security concept going, in your opinion? Because, like Joel mentioned, and as well as Rebecca, I mean, it's an entirely new world. It's actually an entirely new universe where you can securitize anything, right? Hence the name.
Yep.
Tell me.
Yeah, I mean, we have, so we started this in 2017, and kind of from the inception, we weren't necessarily the cool kids when it came to crypto, but we were trying to do things the right way. And because of that, Can
I interject there? That was a smart move, right? I mean, I don't know how many ICO people I met, and some of them were Looney Tunes, but some of them were tried to be serious people. But boy, you guys dodged a bullet there. But anyway, go.
Yeah, well, it was intentional. So maybe we were armored up properly. Looking at the space and the opportunity, it seemed that everything in the end becomes digitized. So you could start with anything that was on paper, it becomes digitized. You can go from snail mail through to music, and now securities, right? We've seen public securities get digitized pretty effectively. You don't know who owns what, but at least the transactions are relatively kind of seamless and painless. When it comes to private securities, it's super painful. It's complicated. It requires paperwork flowing back and forth. Transfers are a pain. And so we saw that as a huge opportunity. And so for us, the tokenization of everything, which is, I think, where we get to in the next 5 years, is something that will create a whole new ecosystem that people can take advantage of, because it's not dissimilar. And I often comment about music because I think people can relate to it. But music, when somebody started ripping songs off of CDs, nobody was actually thinking that there was going to be Spotify or TikTok, right? But what happens is there's unintended consequences. Once you digitize things, new opportunities come up, and we've seen a lot with DeFi. Probably the number one question we get asked is, can we do something with DeFi on Aave or on Uniswap or something like that? And the answer is, well, probably not yet, but in the future for sure. And so, getting everybody comfortable and having the right infrastructure to do that, as well as the option, has been what we've been kind of focused on enabling over the last 5 years now. It's getting I've been in this industry for 5 years, which is, I think, from its inception.
But in 5 years from, you just predicted 5 years from now we're going to be at the tokenization of everything, right?
Yeah. Most cycles are about 10 years, right? So it takes 10 years to get to kind of adoption. We're about halfway through, and it may accelerate and it may slow down. I think the regulatory environment today leaves something to be desired, to be perfectly honest, because there is a lack of enforcement while there is a lot of blustering. And if there was clarity for folks, then I think they could move more quickly and execute. The marketplaces would move. I had an email from one of the large crypto exchanges yesterday, and they said, under our regulatory constraints, we need you to provide this information. And I wrote them back and I said, who regulates you? And there's no answer, because there aren't any. Like, there's no actual regulatory constraint.
And that's what Gensler is actually dealing with now and speaking of.
I don't know. I think that's the directionality on it doesn't look very good to me. I don't think that they have locked into what they want to permit. And I think that they're much more focused on stopping things from happening than enabling people to do things, particularly in private securities. I think there's a huge problem there, and I think it's going to get worse.
So you're saying that you think that they want to stop bad things from happening, as opposed to scofflaws that aren't necessarily hurting people, because there's so much going on.
There's a lot going on. Yeah. What I'm saying is, I think that the regulator today and kind of where they're operating from is that they want to stop retail from trading. That's kind of the mentality. Stop retail from trading. Stop it from trading these private products, which is less information about. They want everything to end up being public on some sort of exchange.
Okay.
And I don't think that that's a practical outcome. I think it's a bad outcome for everybody.
Okay, since you brought this up, what are your thoughts on the legislation coming out of the Senate in regards to the digital asset ecosystem, as opposed to Gensler's apparent opposition to all things that retail touches?
I think it's more of the same, like two different sides trying to get the budget so that they can take control of who gets to do the enforcement. I don't think there's any like actual concern about the retail investor at the end of the day. Do I think that these are commodities? No. Do I think that the regulation provides the right level of clarity for folks? No. And I don't think it makes a marked difference in sort of the actual investors' outcomes and what they can and can't do. I think it's just going to cause more consternation in the space and confusion, which will make it challenging for folks. And candidly, it stops a lot of really good startups that could have significant growth opportunities from being able to get there, because they're not able to access. If you are going to have a vibrant crowdfunding environment where retail investors are buying and selling and trading, like if you're going to have retail in there, they have to have a way to get out. You guys already said that. And to do that, you need to have liquid marketplaces. And there has to be someone on the other end to buy it, right? And today, there's so many limitations on what ATSs can do that it makes it really difficult to have significant liquidity. Even if you're investing and even if you have good product on platform, I can't really point to anybody that's kind of crushing it on the liquidity side. And I'm putting us in the same place.
So what's the solution to that? Because
they need to loosen up the way. Yeah, I mean, they need to loosen up the way and what ATSs are able to do. There's so many different limitations that get put in place with different things you can trade, how they can trade. Can you have market makers, who the market makers can be, how much they can trade on the platform, can retail buy it, how many investors can you have in a deal? There's a multitude of challenges that pop up on secondary that, we've been operating our marketplace now for 9-10 months, and we're, getting through them, but it's going to take us another 6 to 9 months to get all the sort of approvals. And we already know what the problems are. Most of the firms that get in the space don't even know what the problems are going to be. At least we have the experience of having done it. And so these guys are starting out doing new deals, and it's they have no idea the problems we're about to face.
That's interesting. Does anybody, either of you want to comment on what Jamie just kind of shared?
Completely unnecessary for them to have to get involved in the private securities and everything from primary market raising to secondary trading. The fact that they're getting involved today, to me, is a step in the right direction. The fact that they're actually considering whether NFTs are securities or not, and how they're going to be regulated, and whether it should be under the SEC, the CFTC, or banking. Yes, the devil's in the details and all of that, and I don't think they're, to Jamie's point, I don't think they're there yet. And I don't even think, to Jamie's point, that they realize all the problems. I agree with that. But the fact that they're talking about it, to me, is a positive. The other element that I'd put out there is let's call it like it is. If you have a Reg A that's the full 75 million, if IBM had an issue that they put out with 75 million, it wouldn't be trading very much. It's not terribly liquid. We have to understand the definition of liquidity in private securities versus public securities. And one of the things I've spoken about in the past is the markets 30 years ago were investor markets, not trader markets. They turned into trader markets at a certain point in time with high frequency trading and all that surrounded it. But it was originally an investor market where people would go in and invest, hold for a little while, and get out later. This market that we're dealing with has gone back to an investor market. It's a healthier market when it's done properly. And yes, there's a lot of regulation that needs to be sorted in order for it to get done properly. But it's an investor's market. If you're looking for liquidity where you can, buy and sell in nanoseconds and make money, this isn't the market for you. Nor should it be. We want to be able to go to retail players who now, to Rebecca's point earlier, have all that information that they didn't have before. And they can now be intelligent investors in the market. And they want to get in. Now, I'm sorry, getting back to Jamie's point, and if we open it up to allow them to go in and allow market makers to come in different ways and do all the things that Jamie said, which are essential elements, then we can create a real marketplace that has some element of liquidity that makes it a viable marketplace in private securities.
Since we're talking about liquidity, Rebecca, do you want to add anything to this?
Yeah, I think what Joel's saying brings to mind, people can be really hard on this space for things that if you look at the public markets, they have the same problems, right? Like you have a lot of our issuers end up going public. So then I'm always getting the question of how did those Reg A's do when they go public? And if the trading price is down, oh no. Well, like look at the number of IPOs that bankers spend how much and charge how many millions of dollars to price. And then they go public and those stock prices drop as well. Like, but when you're talking about the private markets, you know, you kind of sometimes get painted with this negative brush that would happen in the public markets anyway.
Okay, so part of the future of this entire industry is finding a path to removing some of the friction that's intrinsic to the secondary marketplaces. Is that what I'm hearing?
Yeah.
This has to be fixed.
I like what Joel said. Like, if a new and different kind of market develops, like that's okay, and let's recognize that. Like, a lot of the time I'm spending talking about the factors that are influencing retail investment being different than the factors that are impacting VC and private equity and their investments right now. Like, we need a little bit more time and people to recognize the maturity and the differentiation that this space has. And that's okay. It's new and it's different, and it's a different part of the capital markets that's developing. And that's a really, really good thing.
Yeah, I think, Joel, I think your point that getting back to an investor market is a very interesting concept. And I think, you know, to our detriment to a degree, you know, people got infused with crypto and it just became this huge, you know, buy bust party, you know, pump and dump scheme. And people kind of expect to be able to do that in a regulated securities market. And it's not the same. Or should it be, right?
Should it be? That's right. Nor should it be. There is a protection that is necessary for all investors, institutional and retail. And the more protection that is given with the freedom of movement that's necessary, very often the more sturdy the market and the more it grows.
So it's a balancing act. You don't want, if you go too far, you kill the market. If you go too far the other way, you're going to have, you know, cats sleeping with dogs in the sky falls, and it's mayhem and madness, right? And
look at the history.
And when that happens, yes, when that happens, then, you know, Congress acts, and then everything's destroyed.
That's right.
You don't want our elected officials making any sorts of decisions because they'll definitely break it.
And they need to go to the industry. You know, I think this is where the most important thing that Jamie really said. They need to go to the industry of people who understand and have been doing this, and can then give their experience over and say, you're not seeing this component. You have to understand that here are some unintended consequences of your actions, and recognize that that's an important element of devising the proper schema.
100%. Totally agree with you. I just don't know if those people exist at the SEC anymore. I think that's a challenge. Okay, so let's. I'm going to go to something else. I'm going to go back to Jamie here. You mentioned Exodus. Absolutely, 75 million. The first issuer to raise that online, hit that funding cap level after they increased it last year. That's really cool. Recently, I have seen Securitize participate in different ways with offerings that are global. So there was an offering, I think it was in Japan, that I saw your name crop up. I'm like, what is this? Who is this? What's going on? It was very interesting. And then there was a basketball team in France, I think. I'm like, you know, you got a lot of frequent flyer miles, Jamie. You know, you're getting around here. Not to mention your recent approval by the Spanish authorities to join their fintech sandbox to offer digital securities, both primary and secondary offerings. Going global, you're taking kind of a non-traditional path because, again, you're kind of a trailblazer here. That's the future, isn't it?
Yeah, I mean, I think that one of the things that we learned during the kind of ICO boom that is valuable and is that there is a global marketplace of investors. And if you can really access that global marketplace, you can pull capital in from different markets that didn't normally have access to it. You know, be it from Europe into US deals, US money into European deals. In Japan's case, you know, any sort of outside investment is great. And so we've seen and we've had that kind of vision from inception because we saw the opportunity. And so we've basically been working to put that story together to make it so that, we can understand the kind of regulatory constructs we have to operate within. From day one, we were always accepting international investors, but now to go a step further and try to create a marketplace that's local in Europe, at least for investors, I think is an important next step because, people don't we're here in the US and we deal in dollars, but in Europe, they want to deal in euros and they want to know that the regulations are being handled by their country. They don't the SEC isn't necessarily their kind of regulator. So these kind of pan-European deals, I think, is a really important building block. The Japanese business for us, we've started in 2019 and we've been growing it since then. It's a very institutional market, but the offering that you're referring to in particular was one we did with Marui, which is sort of like the Bloomingdale's of Japan, a very large retailer. And they actually did a self-kit. And so, they're really excited about it. And so are we. So, for us, that's been a nice business that and a country we've been investing in for years. And we'll see, kind of that line of our business grow over the next 24 months significantly.
So you're in Europe now and You're in Asia, Latin America, other regions.
Right now, we're only regulated and licensed in the U.S. We're, the sandbox. Hopefully, in a few months, we'll be able to come out of that with kind of coverage. In Asia, we don't have any licenses to date. We work with regulated entities. In that case, Nomura. So it varies by market and kind of what's relevant. But yeah, we think that Asia is definitely a significant opportunity space for us in general, but we haven't really done too much there yet.
Okay, Rebecca, you're actually Canadian, so you're global by default, right?
Yeah,
that's the one market we don't deal in. Canada's so hard.
Yeah, I don't know if your company is engaging in global offerings or not.
Yeah. I think on this one, Jamie kind of laid out the groundwork, so I'll just agree. Same thing as him, same vision, right? If you're based in Canada, almost every deal you do has an American coming in. So for us, it was a global vision from the start. We've seen many $100 million plus offerings on the system, multi oversubscribed. There's demand in all the continents of the world for US deals. And, for us, building the system flexibly so that we could support exemptions in all those jurisdictions was a key part of my vision. And we continue to see that play out. And the globalization of the capital markets, when Jamie talks about where we're going to be in 5-10 years, I think that's a critical piece of it, right? Is bringing all of this together like both of us are doing and bringing all of that collective interest and players into one ability to do deals together. There's a lot of excitement in different jurisdictions you mentioned, like South America doing a lot of the same stuff that's happening in the US right now. And so the more we use the US as the hub and we can permeate all those jurisdictions, the more companies and founders get funded.
So are you planning to expand Dealmaker into other markets? Is it going to be like Dealmaker UK, Dealmaker EU, Dealmaker LATAM? Is that part of your vision going forward?
Yeah, absolutely. Think about the world as it exists today, right? If I want to order a sweater online and I like a sweater that's in Spain, in the click of a button, I order it and that arrives at my doorstep, within maybe a week. And that's where the concept of online purchases in retail has gone. What we're doing is the same thing for securities, right? It's going to be that way. The exemptions are much more complex, and the work that our systems are doing to back end that is more complex, but that's where it's going to get to.
You don't care where it is. You want that sweater, right?
I want that deal. I want that sweater.
Yeah. I hear you. Joel, do you have anything you want to add about the globalization?
So firstly, we look at it in a bifurcated manner between the investors and the issuers. So from an investor perspective, they're everywhere, and you want to get wherever the issuer is, you want to be able to get to it. So we make sure that AML KYC is done, and it's done differently depending on the region you're in. But anyone from anywhere in the world can invest in U.S. companies as they exist. And in Reg CF, you have to be Reg A, you have some requirements, etc. But you're going to have to find the investors all over the world. And I think all of us are open to having investors all over the world and advertise that that is available, because there are no borders. When it comes to the issuers, that's a bit different. And finding the issuers that are right and making sure that the investors all over the world can get to issuers all over the world. And that's, another element of the next level of globalization, and just as important in making sure we find a solution for it. But there is the ability to make sure that with that globalization, even of the issuers, of a co-opetition environment within our industry, that I think will end up serving us very well. The fact that there are companies in the US that do what they do well, and maybe there are ATSs and exchanges in Europe and Asia, etc. The fact that they can all work together, enabling the universality of the entirety of the investor and issuer community, enables a smoother interaction, and for each component part to be able to be successful in their respective region.
Yeah, I mean, I know of 3 other platforms that are moving into Europe, planning it right now. Some of them are already doing, transatlantic offerings. One of the platforms is already working with an Asian provider. It's just going to happen, and it should happen. It should be frictionless, should be quality deals anywhere available to investors in a regulated environment. That's my opinion. Okay, I have one more question for the panel here before we open it up for questions, because I guess we have a number of them in the queue right now. There's been a lot of discussion publicly and with you people in the past about the decline in public markets. It's a fact that the number of listed firms has been going down for decades now. And this has to do with the rule upon regulation approach taken by policymakers, elected officials, who frequently have no idea what they're talking about. They just think it sounds good, and they feel that they've been elected, and so they better do something. But it's really harmed public markets, in my opinion, to a negative degree. Yes, we need disclosure and we need regulated environment, but you can take it too far. I think that there's a theme out there today that private markets are the new public markets, and it's an area that big money has been taking advantage of for years. VCs, angels, the uber wealthy, they've been jumping ahead of the queue to invest in these early stage companies, and they hoover up all the capital gains before it gets to retail, who ends up buying into an exit instead of an entry point. Tell me I'm wrong. I don't think I am. We're going to start with you, Rebecca.
Yeah, I mean, my favorite example I like to use, right, is if you take an average American household, they can get in on these deals now, right? And say they put $1,000 across 10 deals, because the Reg CF and the Reg A limits are going to make sure they invest an appropriate amount for their net income. And then of those 10 investments, one of those 300Xs, because those are the opportunities that the VCs and the Wall Street have been getting access to, that average American family now has $300K. If you compare that to what their annual income is, that's a massive number. That's a life-changing amount of wealth that just got generated. And so those are the opportunities now that the average American household can get in on. And so, of course, I'm all for that. I agree with everything that you said. The capital markets have changed and evolved, and these regulations need to change and evolve with them.
Jamie, am I right?
Yeah, I mean, without a doubt, just look at the SPAC market and how it's died, right? So it just sucks if people can't get in early enough, and then they get hosed, to use a Canadian term, at the end, right? And so there's clearly been a rug pulled on, and it continues to happen. And it is, part and parcel of companies staying private longer because there are no liquidity venues, because the VCs don't encourage any sort of liquidity. And the VCs really want to control the dialogue as to who knows what about the companies and how it gets funded. And they want less people in the cap table. And, in order to have any sort of liquid asset, you're going to need thousands of investors in the cap table, and you're going to need sellers as well as buyers. And so, that is definitely a opportunity for an optimization, to say the least.
It seems that we've lost the host.
I think he was going to go to you next, Joel.
It's just me. So I'll just pitch in here on my thoughts. Just obviously, I fully agree. I don't think there's anything to disagree with. It's really kind of simple to be able to look at the markets, and it tells you what's happening within the markets. But just to give you some examples, if you were looking at the value created before and after stock went public, look at some of the public stocks. Twitter. If you invested when it went public, you doubled your money. If you invested when it first went private, you were up 540%, 540 times the increase in value creation. Airbnb, you're also doubled since it went public. If you did it while it was private, 6,800 times improvement. The value creation in the private markets is dwarfing the value creation in the public markets. And you were not able to get into it when you were a smaller investor. The big money players were always able to get into those deals, and small investors could not. And now we've created an ecosystem that enables small investors just to invest their amount of money. You're not interested in whether you necessarily became a millionaire. You just want a percentage gain. So if they got 6,800 times the gain, you want to be able to get 6,800 times the gain on your $100, $1,000, or whatever you've put in. And the market now gives you that opportunity.
Okay, so I apologize. I got kicked out here for a second. I had an issue with my laptop, but I was able to switch to the iPad. I somehow I lost all these questions, so I apologize for that. I'm seeing if we can recover those right now. There was one question about quality deals, and I think there was tackled earlier about quality deals, but I'd like to revisit this because this has been a beef with me, that especially in the early days, you would see issuers that were not raising enough money at a ridiculous valuation, and all you were going to get is a cocktail conversation.
Deals where the companies are now revenue generating, much later stage of the game. And so we're constantly seeing that evolve, right? Like there is an element of people just having excitement of an idea and wanting to participate in that idea. For sure. We saw that with the Green Bay Packers offering, right? Where people are investing in that, not because those shares are going to give them any kind of return, but because there's a gratification they have of being an owner in that company. But by the same token, the issuers that we're speaking to today, just getting more and more along the spectrum, which gives investors that diversified portfolio, whether it's super early stage and the returns, like Joel was saying, might be 500x, or it's later and the anticipated returns might be 200x.
Anybody else want to comment on deal quality?
Yeah, well, yeah, we did touch on it earlier, and it's just dramatically changed. But how much of your company you have to give up? The method of raising capital has enabled the issuers to deal with a group of investors that have this somewhat aligned interest. They just want the company to do well, improve, and the stock price to go up, and they can make money. Ownership of it, strategic vision, all of those things. The retail investor is not that interested. They're going to buy into the fact that management is a good management team, and the vision is a good vision, and the product's a good product. And if they've bought into that fact, they're allowing the company to continue on its path. Whereas in the VC world, that has been one of the issues, is that you have to give up a lot, not only in ownership of your company, but control of your company. And we're seeing that the retail investor has, in a sense, empowered the issuer to be successful.
Next question. A longtime industry insider has asked for your predictions about what does Reg CF look like in 3 years. Rebecca, we'll start with you.
Reg CF, I think there will be, well, some of the changes suggested, like easing regulations for portals. We're a broker dealer, so we access it a little bit differently. I think as we streamline, material change requirements, notification requirements, that will all become a lot smoother. A lot of the digital marketing that we're doing, getting better ROAS, that will lead to more capital raised under CF, which will just make it a more commonly used exemption as well.
Anybody else? Joel, Jamie, thoughts?
I mean, I would hope to see that, Reg CF becomes sort of a replacement for a Series A in time. It may be a Series Seed Plus, but I think with up to $5 million, if you can build a grassroots user community, you can start to set the tone kind of on your own, and it starts to replace it. As the VC market has shrunk, and it probably will shrink because LPs won't have as much cash just sitting around. There's a good opportunity for really great companies to get funded. And normally, in these kind of bearish times, that's when you get really great companies get created.
Yeah, I think that Reg CF should be increased.
If you want liquidity, you're going to have to crowdfund because there is no other option. You're not going to get liquidity through a Reg D. So you need a lot of investors in the deal. So that's, if we're going to get to a liquid marketplace, crowdfunding ends up becoming much more significant.
And you start to engage with that community like we were talking about earlier, right? So you start with the community on a Reg CF. Maybe if it goes up to 20, you do a couple Reg CFs, then you go up to an A. And that community, one of the things we've launched is shareholder communication portals, right? So you can continue to speak to that community, re-engage with them, and then go back to them on the next round. They know how the company did, and they're happy to invest again.
Exactly.
The key is going to be to look at Reg CFs that are successful. And if we can get, and a lot of them are a lot more successful than they had been even a year or two ago. And if that keeps up for another year or two, then it is going to become a go-to in capital raising tool, because the first place you're going to go is say, let me raise a Reg CF, get my $3-5 million in. I can be really successful.
Yeah, I'd like to see some data on that. It takes some time, but I'd like to see that firms they haven't died. They haven't turned into zombies, but they've actually gotten some traction. It doesn't have to be a unicorn, but over time, I'd like to see that data, and I think that would be foundational for the industry going forward. There's actually a question here for you, Joel, about how you get a private securities ATS approved. I guess.
How do you get an ATS? Blood, sweat, tears, and a lot of time. It takes a lot. It really does take a lot. At Rialto, from our perspective, we have the founders. This is the 9th ATS that we've dealt with, so we were quite familiar with the world of ATSs in the public markets, navigating the regulatory requirements. I don't want to bring up bad memories. I'm sure Jamie has a few of them in his mind, just like we do. Of all the dealings that you had to go through and answer to all the questions. People think it's just filling out a form. It's a lot more. The regulators are looking, to their credit, looking to protect the investors, the retail and the institutional investors. And to go through it, you're going to need to have the experience of what it means to build. We're allowing it because once you become an ATS, once you become that quasi-exchange, there is a responsibility to the investor community in the world to make sure that things are on the up and up.
Somebody asked about why real estate is not more popular on Reg CF platforms. I will say this: there's one platform that mainly does real estate offerings under Reg CF, and there's some platforms that will utilize the exemption for real estate deals. But I think it just comes down to the amount of money you can raise, right?
For us, it's a couple of things. Like we do have some real estate issuers that use it well. I think in digitally marketing real estate is a little bit more challenging because the way you market a Reg CF has to be really grabby and catchy and video based. And so with real estate, depending on the deal it is, that can be a little bit more challenging to do. But depending on the deal, like some folks can do it very successfully.
Anybody else comment?
There are a lot of component parts within real estate that don't necessarily lend themselves at times to Reg CFs. The ones that do it successfully are very successful, and they've managed that. But you have to consider, like you said, Andrew, it's how much money you can raise. But there are also some differences in what kind of returns you're going to be able to get, and what kind of returns they speak to. What are some of the other funding components of that real estate? Are they getting construction loans? Are they getting other pieces that potentially complicate the investment itself, that don't always lend themselves to that kind of marketplace?
Yeah, I mean, in Japan, we have a very successful real estate issuer doing properties on an a la carte basis. And in the US, we actually have a new customer, two new customers that are doing real estate, which you guys will see come out shortly, which I think, will be very well received. So I think the real estate space, everybody thought it was going to be an opportunity. It is an opportunity, it's just very complicated, and it only suits, like you guys said, certain types of properties. It doesn't actually suit every property. You're not going to be buying the Plaza Hotel as a token, unfortunately.
Right.
Okay, we're going to just do final words of wisdom here. Your expectations for this market 10 years from now. I'm going to go around, starting with Rebecca. Your thoughts?
One global capital market.
Like it. Jamie?
Again, Rebecca. I think we have a really great way to kind of mark to market, and you've got a really vibrant kind of ecosystem around private securities.
Awesome. Joel?
10 years is too far out, so let's even make it shorter. There is going to be a combination of digital markets and private securities, and that combination is going to lead to
Join us for this webinar. Please, reach out to me via Twitter or otherwise, and provide your thoughts and input, and certainly reach out directly to Dealmaker and Securitize and Rialto, because their quality platform is pursuing an ambitious, interesting, section of capital markets that I need for the future. So thank you, everybody, for participating today, and we look forward to engaging with you at our next webinar. Everybody have a good day. Thank you very much.
Bye-bye.
Thanks, guys.
Thanks.